I've, you can see, given this presentation the title of Confronting Financialisation. I partly do that because we're currently in receipt of a EU grant to study financialisation. And this is a project which involves 15 partners from across Europe, and mainly heterodox economists and social scientists. And whenever I meet my heterodox friends, they sort of say, how the hell did you get such a grant? And the explanation I sometimes give is that we were time-wise lucky. We were applying in late 2009, when there was about a 6-month window in which heterodox economics was taken seriously by funding bodies. And since then the window is closed. And if you then look at the subsequent grants which the EU have been giving out, the window is firmly shut. I, to some extent, apologise for using words like financialisation, which some of you may be familiar with the term, many will not. And clearly in this area there's often a problem. We use all sorts of words ending in isms or isations, and we're familiar with many of those, whether it's privatisation, globalisation, and now financialisation, and various other isations that one could introduce. I think the common theme of those I mentioned, privatisation, globalisation and financialisation, are that well, these can be seen, however one defines them, as major features of the last, 30, 35 years. Sometimes we date this round about late 1970s, early 1980s, but changes in the national and international economies which started round about that time, although one can always find examples of earlier phenomena in this direction. I want to make really two areas I want to look at. Firstly, let me just explain what I mean by financialisation, and I think as a concept I think you will in some sense recognise that it's been happening. Now, one widely quoted one is that it means the increasing role of financial motives, financial markets, financial actors and financial institutions in the operation of domestic and international economies. It comes from, that one comes from Jerry Epstein. I think that we could recognise that the financial sector has grown enormously on, if you just take very crude measures like the share of employment in the financial sector, or take, at least prior to the financial crisis, the scale of profits in the financial sector. These have grown very considerably, although over things like employment, it's still the case that the financial sector is not a particularly large provider of employment. And we could also say that financialisation has been, although we didn't use the term, been occurring for a long, long time. If we take the title of David Gribble's recent book on debt, The First 5,000 Years, we might say, well, it's been going on in a sense for 5,000 years or thereabouts, but we can see other stages, particularly late 19th century, early 20th century, when, again, the financial sector grew rapidly. It then went into something of a decline, a period which might call definancialisation, 1930s, 1940s, and then starting in the early 1950s, the financial sector started to grow. But here, particularly looking at the changes which have taken place since round about 1980. It's not only a matter that the financial sector has grown, but I think there's two other important features of that. The first is how it has changed. It's not just that, for example, the banking system has grown. It has been growth in the scale of financial markets, growth in the trading of financial assets, which have become very large. I mentioned this morning of high-frequency trading, development of derivatives and securitization, but this general sort of marketization of financial assets, but also the general growth in the scale of financial assets and liabilities relative to the size of the economy. So it's not just that there are more financial assets, but also more financial liabilities. And often the problems have arisen when there's been an imbalance between the two, that if the value of financial assets falls, suddenly whoever holds those financial assets and liabilities are in difficulties. The other aspects of financialisation have been deregulation, privatisation, and I think perhaps significantly, I would call demutualisation of the financial sector. I should have said by way of introduction really that this process of financialisation could be seen as one which has affected most parts of, if not all parts of the world at various levels and various stages, although one can emphasise its role in the Anglo-Saxon world, but it is one which has gone round the world and now easily spreading into many so-called emerging markets. And part of the project we're looking at is, one comes out of that, is the extent of the and the nature of the changes have been different across countries, but I think all countries, or at least we're looking at industrialised countries, all industrialised countries have experienced this growth of financialisation. So deregulation we're probably familiar with. I think also an important aspect of financialisation has been and probably related to deregulation and liberalisation, is the frequency of financial crisis. We tend to discuss the so-called great or global financial crisis as though it was almost the only one. And it somehow came out of the blue. Well, to some extent, of course, it did come out of the blue, at least as far as many people were concerned. Some would argue that it's better to think of it actually as the North Atlantic financial crisis, since many of its origins were in the US and the UK, although obviously it spread. But a general feature around the world has been the occurrence of financial crises. One can reel off a number of the major ones, the 94 Mexico, Latin American one, 97 East Asia, and so forth. And two asides there, one looks at the listing by the IMF, they have managed to come up with, I think, 400 financial crises since 1970, which works out at average of 2 per UN member country. Now that's they do use quite a broad definition of financial crisis, so it includes, for example, exchange rate crisis like so-called Black Wednesday in the UK. But nevertheless, it is a frequent occurrence and has been much more frequent than prior to 1970 or 1980, so there's been that increase in financial crisis. I think the many other aspects of financialisation one could talk about, but I think the other one has to recognise is the political and social influence of the financial sector. I think perhaps here that almost goes without saying, but just to note it, because clearly this political and social influence is going to be perhaps the major block on any significant reforms or changes or restructuring or whatever else there might be. I think one only needs to look, at least from this country, at what has happened with really the financial transactions tax. It's gradually been watered down in various ways, because in this country blocked out from all considerations. But even if you look at examples of where some form of financial transaction tax has been introduced, it's been extraordinarily watered down, often easy to evade, and so forth. Not to mention, of course, the costs of bailouts and all those aspects. Now, one other aspect of this financialisation, I think, has been that financialisation has actually become harmful for the real economy and perhaps even harmful for growth. I sometimes think, somewhat tongue-in-cheek, that if one is looking for rather slower growth in the future, maybe we should get the financial sector to grow as fast as it can, because it actually has detrimental effects on growth. I don't seriously, at least I hope I'm not being filmed, and that clip will appear somewhere. But so from that, and interestingly, I find at least, in the past, much of mainstream economics, and more generally, was concerned with the relationship between the growth of the financial sector, what's called financial development, and the real economy. And generally it was found there was a sort of positive sort of relationship. One could discuss what the mechanisms were, what the causation was. One of the things which seems to me to be emerging is that the growth of the financial sector has been actually harmful to growth. Not to say because its composition as well, which we probably should be more concerned over, but that it has it has done that. And so there's been this, I think I would put the argument, and if you start thinking about it, well, how's the financial sector grown? Well, much of its growing is the development of derivatives and securitization and the trading in those, which I've forgotten who it was this morning, said, do they had any value, as it were, or any benefits? And I think the particular question was raised in terms of so-called high-frequency trading. Now, when you ask what is high-frequency trading, well, it's trading which takes place within the nanosecond. And there's a book which I find interesting by Michael Lewis called Flash, where he talks about the development of high-frequency trading. And this illustrates, I think, the loss of resources which goes into it. Because much of his book is about the laying of the most fast transmission between New York and Chicago and elsewhere. And if only you can speed that up by 2 or 3 nanoseconds, you can gain from, or the traders can gain, take advantage of different prices in different markets. And then so an enormous amount of investment went into building these very high frequency transmission mechanisms. Of course, high frequency trading does other things. It does, firstly, the people who write the algorithms for this high frequency trading are usually highly trained mathematicians and engineers who could be somewhat better employed. It also raises issues for corporate governance, because if you're buying and selling shares by the nanosecond, what interest have you got in the way in which the corporation is run? All you're interested in is what's going to happen to the price in the next few nanoseconds. And so you're then, as often people say, well, basically you're trading in the casino. But then the puzzle is, if you go to the casino, we lose and the bank win. And I think, again, what Michael Lewis indicates is that was perhaps literally true, because who gained out of high-frequency trading? Well, it was Goldman Sachs gaining at the expense of their clients by the way they were trading. So I think we have the point that much of the growth of the financial sector has been, if anything, dysfunctional, and brings all sorts of other harmful effects which we are familiar with. How much longer have we got? Okay. The other part was, I was going to say, was thinking about, and some of this has already sort of come up, and I think, is how we should be thinking about trying to restructure and re-regulate the financial sector. And here I think the main focus should be on making the financial sector serve the real economy rather than serving their own interests, and also how can we ensure that the way in which funds are allocated, which is after all what the financial sector is in effect doing, is allocating funds and finance, how can that be done in a way which is supportive of green, environmentally friendly or other socially desirable investment? Let me just list up 4, which I think we've discussed to some extent before. Firstly, the importance, I think, of financial transaction tax to significantly reduce the size of that trading in financial assets. And the more it can do, in my view, the more it can actually reduce that trading, the better. So it shouldn't, although it may raise funds, we shouldn't be too bothered about what the scale of those funds are. The significant thing is it's taxing something like we tax tobacco because it is harmful. Second, the need for the development of state development banks to channel funds into investments which are consistent with what I would call a green industrial strategy. There are some organisations, institutions which could already be used and diverted for that purpose, but a much greater role for the State Development Bank, and the setting within that in a context of what I would call a green industrial strategy. Thirdly, the development of regulation and other financial devices to place requirements on banks for a high proportion of their lending to be devoted to environmentally friendly investments, particularly the use of reserve requirements which favour green funding, but seeking to impact on the ways in which funds are allocated by banks. And finally, which some has come this morning, the fostering of a diversity of banks, including mutuals, cooperatives, local and regional organisations. I think diversity in itself, in this context, is probably a good thing, as it were. It may foster a more stable, or less unstable, I should say, financial system. But I'm sure we can develop many arguments as to why mutual cooperatives, local and regional organisations would be beneficial for the way in which funds are allocated. And again, just to final part, I think one of the aspects of financialisation, to mention, has been, on the whole, the destruction of state development banks, mutual organisations and so forth in this direction, and its ways in which we can revive those will also have a contribution. But to end on a pessimistic note, the political and social power of the financial sector is not to be underestimated, and all of these would not exactly run in their interests.